Are equities attractive right now in their own right or only in relation to bonds?
Good morning. I mean, I come from equities background, so I'm obviously very biased, so I do like stocks. Fed model is one way of kind of saying that bond market is expecting a lot more negative outcomes than equity market. And I probably side with equity market thinking that, yeah, things are not great, but not a disaster. So yes, we do like stocks.
The negative outcome that Maria is referring to, Arend, that bond markets are showing, is that justified? Are bonds pricing correctly for where the global economy stands right now?
It's tricky because I think we're still in the process of incorporating what happened in the last few days into our forecast. So that was a big deal, right? So we had modeled sort of a worst-case trade war scenario in June. And with the 10% increase, we got to about 40% of that worst-case scenario. But what happened the last couple of days got us to about 80% of that scenario. So I think the street's still busy pulling that into the numbers. I think we're probably moving from an environment that was going sideways and sort of priced accurately by bond markets to something that's going a lot lower. And so then the question is, you know, the front end looks really extreme, right? So you look at what the U.S. curve is pricing, what the European curve is pricing. Difficult to see it pricing much more than that, but the back end can frankly go anywhere.
Maria, what's so interesting here, and we're thrilled to have both of you with us today, is UBS through Mark Halfley went to a very cautious call on equities worldwide. I love what you have in your note on U.S. equities. You say, what's not to like? State the optimism on investment in United States shares.
I mean, first of all, I just done a Bloomberg radio interview, and apparently optimists live longer. So I'll try to stick with the optimistic side. But I mean, what we like about U.S. stocks is very strong or superior growth opportunities and more profitable corporates. So if you look at things like return on equities, it's almost twice as high as the next best market. Earnings growth outlook, again, almost twice as high as the next market. Yes, those stocks are trading at a premium to the rest of the world, but this premium seems to be justified by superior fundamentals. The other thing, I mean, very similar to kind of Naira's chart on Fed model, if you think about kind of shareholder return in U.S., so you can kind of think of, okay, dividend in U.S. 2-3%, depending on where you're looking. And then you can throw in another probably 3% of buybacks. So what you're getting is at almost 6% of shareholder yield in U.S. So, I mean, to find me a bond market where you get 6% yield, I mean, you probably need to go to quite risky emerging market and probably compare it. I mean, in that world, yes, risky stocks maybe sound less risky than those bond markets.